Yeah, thank you very much. This was really kind of a nice introduction, and thank you for having me. My voice is not the best for today, but I think for the talk it will be lasting for the roughly 40 minutes that we have in front of us. I'm also looking forward to your questions. Yeah, my topic is AI First Finance, how AI is reshaping an industry, and this is a topic that keeps me busy since years now, actually, and it's a pretty exciting time actually to be in the finance industry and to witness firsthand how AI is gaining ground and having more and more influence. So I myself am trained, let's say, in classical traditional finance, but maybe a few words on that a little bit later. Yeah, let me dive into my slide deck. I would start with the first introduction, since I got this wonderful introduction already by the organizers. I keep this quite short. Actually, here, just for you to have a link, of course, the slide deck will be shared. You see the URL to the slide deck also in my browser, tpq.io. There you find basically all the information of what we do. It's Python for finance and a bit more. We do training, we run platforms, we have open sourced packages. I've written a couple of books, we provide services, and we run events ourselves. But the core topic is and remains now since a couple of years Python for finance. The AI Machine is a more recent project where we have built a execution platform for AI-powered Python-based strategies, which has become, even for retail traders today, a valid option, right? This was the domain of the biggest institutions with millions and millions of tech budget, but today with a regular notebook on your desktop and a Wi-Fi connection to the web, you are already good to go in general to do algo trading on your own. Fantastic times. Here, just as reference, if you want to dive into the certificate, which was mentioned before, where we train people around the world, professionals, as well as academics and students in Python for algo trading. Here, the long story, I keep it short and skip over it just for you as reference. Yeah, maybe a minute on my newest book. So when I talk about AI First Finance, this book basically goes back to the roots of traditional finance. We have here topics such as risk return, pricing of instruments, expected utility theory, like the cornerstones of traditional finance covered, but based on Python, right? So we have today the power of Python and other programming languages which allow us to introduce these topics in a much more interactive way. So when I started studying, I went to the library, I picked up a couple of books or papers and tried to understand what the authors were writing. But today you have more like an interactive environment where you simply type it down and you see what's happening. You can change parameters, you see the change in the outcomes, etc. So I still find it really exciting, in particular when I'm able to teach these topics. So my most recent book here, but it's a starting point. So the others are like maybe as a second, third step, but this is I would say a good starting point to get into the world of Python and finance. That's my best-selling book, if you like. Python for Finance has become a reference work in the field. It's also much thicker. The other one has 200 pages, this one 710 pages, and there is much more to write and to learn. I have also last year published 2 more books, and I think the one on the right-hand side, Artificial Intelligence in Finance, is what best fits to today's talk. But Python for algo trading is also a domain and area that we cover primarily based on AI algorithms, machine learning approaches in this content, right? And you see here also from idea to cloud deployment, even like these wonderful scalable technologies in the form of relatively cheap, easily scalable hardware. That's also something that even retail traders in the field today have at their fingertips. Fantastic times again. I'm still pretty excited. These 2 books are more my quant finance books. This is where my background lies. My PhD is in math finance, and they use Python for finance. They don't really teach Python, right? So the other books are more like targeted towards those who want to learn Python for something. Here, Python is used to do something in this context, right? So for those who are working on option pricing and then more like on the financial engineering side of things, these are the 2 books probably to pick up. We also run, and I want to emphasize this, communities around the world, basically in New York, in London, in Paris, Berlin, Frankfurt, etc. But these days we have I don't know. On the one hand side, we were kind of driven into the virtual digital world, but on the other hand, this opens opportunities for people from other corners of the world to attend our meetup events and other events. So even if you are, let's say, far away from the closest meetup that we run, location-wise, you still can benefit from our virtual meetups or recordings that we post, or the resources that we also put on the site and share with our meetup members. So have a look. Python for Quant Finance is the biggest one, like 3,500 people roughly currently member here in London, where it all originated. So to the talk, history of finance. Just to when we want to have a look at the future, I think it usually pays off to have a look at the history as well as a starting point. A brief review of AI success stories, then where we are coming from in terms of math and what is called the physics envy and the beauty myth in this context, and where we are now, right? What is data-driven finance? What can we say about efficient markets like 30, 40, 50 years after the concept was invented or found or formulated, right? And how do people try to overcome the curse, if you like, of efficient markets from the traders and investors' point of view? And I want to conclude with like two basic strategies that seem to crystallize more and more. I want to conclude with the last single slide, right? So let me dive into the history of finance. And it started with the ancient period here, according to the book by Rubinstein, History of the Theory of Investments. This is a period mainly characterized by informal reasoning, rules of thumb, experience of market practitioners, right? And it only started at the beginning of the 50s with Markowitz's wonderful theory of mean variance, portfolio construction, right? So the classical period for 30 years. And this is what I said before. My newest book is about the oldest period in this context, but all based on Python and in a modern disguise, if you like. The modern period, this is where people started bringing more and more sophisticated math to the field, also with regard to numerical methods, where people suddenly noticed that there is stochastic volatility and all these stylized facts that need to be accommodated in order to have realistic models. So my book, Derivatives Analytics with Python, I think is closest related to this area. Then we have now the wonderful world of computational finance, if you like, computational period. So where we suddenly had tremendous compute power available, the big institutions running clusters with thousands and thousands of nodes, right, to do their risk management, trading and pricing, right? Hard and software have evolved tremendously and made that period possible. Python for Finance, I think, is a good reflection, where you find topics such as high performance IO, performance Python, data science on a large scale, right, and pricing based on Monte Carlo simulation, all things that haven't been really available a longer while back. Now we are entering the next period, the artificial intelligence period. Every financial institution around the world, even students at universities, are now applying ML, machine learning, artificial intelligence methods to the financial field. And it's a shift from a simple and general linear modeling approach in finance to the use of advanced models and algorithms from AI. Think in terms of deep neural networks, for example, that are pretty powerful in dealing with high dimensional data, non-linear relationships, and all these things that somehow have been neglected or assumed away, let's say, from a theoretical point of view in the financial domain. And this is where we are coming from, and why now AI? Why at all, right? So this is the question, why try people to do this? First of all, in finance, always there are billions and billions at stake, right? If somebody has a breakthrough with regard to some, let's say, theory, model, implementation approach, this might mean above average performance in terms of returns. This might mean billions of additional profits. This might mean a competitive advantage compared to others. And in that sense, of course, the industry is trying to leverage what is there as best as possible. And what is there, for example, is reviewed nicely, I think. It's an easy read and really entertaining, I think. Here the book, How Smart Machines Think. And this kind of like captures the history of how AI has been successfully deployed in different areas, like self-driving cars, how it all began, recommendation engines, playing Atari games, image recognition, classification, speech recognition, playing the game of Go. You probably know all these success stories, but I think this is one of the nicest summaries of what has been done there. So AI success stories, I want to pick few of those that I find most intriguing or where I was like really amazed by playing Atari games when I was young. Actually, I'm old enough to have first-hand experienced Atari 2600 console with the games, right? So this is something you might recognize or not. The breakout game is still around for sure, but the consoles obviously not anymore, right? This is how they looked, with a little bit of wood even there, right? And the joystick, this iconic joystick. And what really got me into the field of reinforcement learning are success stories here by DeepMind, where they were able to first come up with an interactive environment, a card learning environment, and to play Atari games on a superhuman level based on a variant of Q-learning, one of the reinforcement learning and one of the most successful reinforcement learning algorithms in this context, right? And that's something really for me where I had like a proper relationship to chess as well. I come to chess in a second, but not that much to Go, which was then really where the general public got aware of what reinforcement learning and AI can do in the end. So Go and AlphaGo, this is where I'm intrigued and amazed by, but I never played in my life the game of Go. I read as a first book about superintelligence or artificial general intelligence, a Nick Bostrom book here, which came out in 2014. And in 2014 he writes, Go playing programs have been improving at a rate of about 1 dan per year in recent years. If this rate of improvement continues, they might beat the human world champion in about a decade. So for those of you who followed along, you know that it was much, much faster. And Nick Bostrom is one of the most recognized and well-known experts in the field. And nevertheless, he said 1 decade. And what happened? Actually, a year later, the European champion was beaten, and in March 2016, the world champion was beaten. So it was roughly 2 years, maybe a little bit less than 2 years after the book has published, that this big thing was cracked. Right, the big prize here of beating the world champion in Go chess was a story which was took place a bit earlier, and to see here the evolution. I don't want to get into the details because if you have access to the slides, feel free to follow along. Also, some links are behind these screenshots so that you can read the full story. But the systems have become much better over time, and this at the same time by even saving lots and lots of compute power, right? To see how good they become on the upper right hand side and how the power consumption has decreased at the same time. So it's a fantastic success. But now getting back to chess. Basically, I said this was a story which took place a bit earlier, actually at the end of the 90s already. The world champion Garry Kasparov was beaten by a dedicated machine, 10 million investment by IBM, dedicated chips, right? And today you pick your iPhone, you pick your Android phone, whatever you have in your pocket, right? And it is better than any grandmaster on earth, right? Depending, of course, on the chess software that is on it. But on a general level, we can conclude that the game of chess has been cracked by the machines quite a while back, even decades ago already. But what I want to highlight here is that the success story of Go was afterwards easily translated to the chess world, where actually 9 hours of self-reinforcement playing by the reinforcement learning agent was enough to master the game of chess. And that's really like, this is somehow replacing decades and decades of experience with computer chess, of experience by well-established grandmasters in the field and their knowledge, their know-how, their rule sets, right? So 9 hours of self-playing is enough to master the game of chess. And for those of you who are as old as I am, maybe War Games, the movie from the 80s where the machine is playing tic-tac-toe against itself and discovers all the rules, that's kind of like comparable to what was science fiction back in the 80s here with a really complex game of chess. It was accomplished. Now turning our attention to finance, in the sense of that, of course, AI has had tremendous success in fields where other approaches failed or can't keep up, let's say, with the level of performance. But what about finance and finance history, actually? Yeah, we have two expressions here, physics envy and a beauty myth. Where is this coming from? So first of all, the beauty myth is something that is even found in what they call the hard science, right? Finance, of course, from a certain point of view, is more like a social science because people are interacting with each others in the markets, or they bargain one-on-one or whatever. So there are people involved, and usually people say, well, where people are involved, it's difficult to model. But with the hard science like physics, people say, well, that's kind of more easy. We can apply math, right? This should be all like easy to formalize and well structured. But here's also a wonderful book. It was published in 2018, and it's a critique about how far physics has come in terms of like introducing math, maybe even wonderful math, not to be understood by everybody, but maybe wonderful to many working in the field. But the math might be a little bit too elegant, too wonderful, because it more often than not these days doesn't fit with reality, right? So here, when you read this quote, they were so sure they bet billions on it. For decades, physicists told us they knew where the next discoveries were waiting. So the experiments didn't reveal anything new, right? In the physics area, billions and billions are invested for the Large Hadron Collider and other institutions, right, to figure out whether there are indeed these new particles that somebody has assumed, etc., right? So that's kind of like a costly endeavor, right? So what failed physicists, and now we come to the major conclusion, wasn't their math, it was their choice of math, right? It's not that math is bad itself, but what math you used in this context. They believed that Mother Nature was elegant, simple, and kind. About providing clues, they thought they could hear her whisper when they were talking to themselves, right? And she said nothing loud and clear. So even the hard science suffer from trust, belief in elegant, wonderful math. And when we have a look at finance here, it's of course very simplifying. I've just put in here like the microeconomic foundations variant, or here a book that I really like that I used for my undergrad and grad studies, my PhD, right? Finance theories. It's a nice summary. And you find there wonderful, nice, elegant theories like expected utility maximization, equilibrium theory, normal distributions play a major role. Linear relationships are found all over the place, but here where you see the axis, that's simply stuff that has nothing to do with how the real world works, right? So we have there the major issues. On the other hand, when you think in terms of trading, you probably hate efficient markets, because if markets are efficient, you shouldn't be able to make any superior profits compared to the market. But disciplines such as arbitrage pricing, so option pricing, in a more narrow sense, they depend on efficient markets, and this is where we see success stories, right? Not in explaining maybe why Tesla stock has a value of X, Y, that, but if the Tesla stock has a value of X, let's say, then we can almost properly price options on that stock, right? This is where we see the success stories, because everything that is related somehow to efficient markets is where the whole story works. In theory, normal distribution is assumed in reality, and these are real numbers on the right-hand side. On the left-hand side simulated, right? On the right-hand side real numbers. There you see that the reality here on the QQ plot doesn't look that way. And we also know that it's not as simple as having a linear relationship, a linear regression from the returns of a stock. Let's stick to the Tesla example, and the evolution of the market in order to come up with the future performance of such a stock, right? So in other words, I think it plays a role whether Elon Musk says something on Twitter or not, whether they are successful with their Model 3, Model S's, Model X's, more so than what the general market does. Of course, there is some influence, but of course there are many, many other important influences. And the world isn't as simple as most finance books still these days want us to believe. On the other hand, we've had this in finance, in economics all the time over decades, right? That people say, well, in physics they are so successful with wonderful math. Why can't we use wonderful math as well? But probably it isn't the case, simply, right? So you can read here, and there's also, I think, a link, or you find it on the web. This is free to download, pretty interesting read, how your trust in elegant math, right, can lead you astray from the real issues at hand in this context, right? So physics envy has also created a false sense of mathematical precision in some cases, a false sense of the precision, right? You can calculate many things according to the standard finance formulas, but the question is, what is the worth, what is the value of these calculations? So data-driven finance, now we are entering the modern world. When I was talking about the periods, computation has something to do with data, obviously, with algorithms implemented on data, or we create lots of data. Think in terms of Monte Carlo simulation, where you might simulate the evolution of a stock price 100,000 times over time, right? So either we have data or we create data, but typically these days we are dealing with lots and lots of data, and this is what drives standard practical finance these days, much more than kind of like theoretical formulas have done in the past. So where we are coming from, from the print world, right? Where we go a couple of decades back, the only reliable source where people could read something, learn something about the financial markets have been the financial news, right? So all these publications, the two I think most well-known ones and widely read around the world, are available since a couple of decades, right? And even in the 50s, people read this. Even earlier than that, right? When no computers were around, and not to think of having computers, desktops in the households, right? This is where we're coming from print editions where in the morning people picked up the newspapers and then try to make sense of what was happening and try to make sense of what might unfold on that day or going forward, right? But today, at least, people can log in 24/7 around the clock. So I have subscriptions to both Financial Times and the Wall Street Journal, and you simply log in and you can read that. So you don't need to wait until somebody brings the newspapers to your doorstep, or until you have time to walk over to the news store. You simply have it, and update it also more frequently. So the frequency alone with which these online articles are updated, of course, is much, much higher than what you see printed. Once it is printed, there might be some other run with some corrections or whatnot, but usually let's think in terms of one print per day, roughly. And here we have multiple updates, continuous updates, if you like, during the day. But still, this is not enough to keep up with the markets, right? What professionals are relying on are the terminals these days, right? And this is going in real time, and I even have it open here so I can have an overlay, and you will see that things here, in particular the news, are updated on a second basis, sub-second basis, depending on what you are interested in, right? So this is what practitioners basically rely on since, also we can say, decades, like the Bloombergs and Thomson Reuters originally. This is now Refinitiv, and Refinitiv Workspace, the latest iteration of their interactive terminal, right? And you find there that much information that it's pretty hard even to navigate it. Just think of Google, but for the financial world. And there is so much stuff that you can find there. And it's not the availability of the data, of the information, it's simply how you process it as a human being, right? There are, of course, the professionals that type pretty fast and look up left and right and up and down and compare and retrieve, right? But it's still probably too much alone just to follow the latest news in this context. So terminal is, of course, a standard, but when we think in terms of the data that is arriving, and here we arrive at what characterizes data-driven finance, it's simply the powerful APIs, and not that much like the terminals, the web pages, or the printed newspapers anymore. When we see here, that's a good example for Apple. Like a few days back, I've created that screenshot. For 15th half an hour, we have 41,000 data points here, right? For half an hour. And Apple went public some 40 years ago, and 250 trading days times 10, 2,500 times 4, roughly, rough calculation here, 10,000 data points in terms of end of day. If we think in terms of open, high, low, close, we arrive at 40,000 data points. What you see in terms of tick data, this is just half an hour, right? We have half an hour for 40,000 plus data points. And who can ever follow this? Who can, or wants even to print it out and to read through it? This simply doesn't make sense. So we have arrived at the point where there's so much data created on a minute by minute, even second by second basis, that human beings are simply overwhelmed in trying to follow along, right? There's simply, right, no chance. Even for large groups, it's not a matter like of scaling up, like instead of one having 10 people on a team or 1,000, it simply doesn't work with regard to the speed. Even if you scale it up, nobody, even large teams, can follow along. But the machines obviously to the rescue. For a machine these days, it doesn't really matter whether there are 40,000, 400,000, 4 million, 40 million, or even 400 million data points, and modern machines can easily cope with such data. But you might say, well, I still want to read the news and to be informed. Yes, for sure. But when we recognize that there are roughly 1.5 million news articles on a daily basis that are published, that are processed by the data providers, who shall ever be able to keep up with that, right? 1.5 million, that's really that's a huge number. And there's lots and lots of text. And here, for example, I've picked one recent example here. The last Apple event was on the 18th of October 2021. Right, here's the link to it. It's not clickable because it's a screenshot here, but you see the link and it's easy to figure out. And of course, there have been the new MacBooks that have been published, and there is now lots of news around the event and what has been published. So here I only pick 5 headlines, not more. So there are of course hundreds and hundreds of these. It's just 5, right? And these are just the headlines, and then you can go and dig deeper. For example, in the very first of the 5 headlines that I show there, and you then can read here the full text, right? Even if we have hundreds and hundreds of news articles for one topic alone, there is still the complete text. And we know that machines these days, given that we have natural language processing, NLP, available, are also better at reading text. So we can maybe distinguish between reading and understanding, right? I'm not saying that the machines can understand everything in this context, but they can, of course, summarize stuff. They can provide you, let's say, with word cloud representation, and they can do quite a bit more, what is much faster done by a machine, by any machine, that, again, a human being or a team of human beings, even large teams, can accomplish. So technology is required to process all the data that we have available these days, and the data availability is growing and growing. So maybe all this data might be the way out of the problems with traditional finance, right? Even if we can find such nice formulas as F equals M times A or E equals MC squared, right? We might, based on the increased volume and velocity and variety of the data, maybe might be able to come up with new conclusions, new approaches, like natural language processing, right? This is also a discipline, English language, other languages, that you cannot put into like 10, 15 equations that explain the language world, right? It simply doesn't work. But with lots of data and machine learning AI approaches, people were able to get a handle on this big beast, which is called language. And finance might be closer to language than it is to, let's say, physics, what we have called the hard science. So the Python ecosystem, you know, I'm a Python guy, is well equipped. There are other technologies and languages out there for sure, but dealing with the data is a matter, today, of hard and software, and we have it available, right? So it's not that we need pen and paper anymore or whatnot. So we have it available. We just need to properly apply the algorithms that are there. So efficient markets, what are efficient markets all about? I don't want to go into the details probably. If you have anything to do with finance, you know what this is about, right? It simply says, and I jumped to the conclusion down there, if the random walk theory is an accurate description of reality, then the various technical or chartist procedures for predicting stock prices are completely without value. So it simply says that you have a look at the price of the Tesla stock right now, and no matter what you believe is, the market is supposed to incorporate all the information that is available, and the market has agreed, the market means the thousands of investors and traders and bankers, etc., have agreed on this being the appropriate price, right? So that's the idea. So there's no value in going back in time and saying, well, what was the price 10 weeks ago or yesterday or the last in the last 5 seconds, 5 minutes. So history, in other words, shouldn't play a role. That's what efficient markets are about. Or here, my favorite, it's the more formal one. A market is efficient with respect to an information set. Think of all the data that we have. If it is impossible to make economic profits by trading on the basis of this set. So we have a look at the data, and we shouldn't be able by applying whatever technique to profit from any insights. But now people, and this is what I said, why are people so interested in applying AI? Yeah, because if you can overcome market efficiency, if you discover market inefficiencies, then you can make maybe billions. And the scientific method, which to some extent characterized finance as well, but not to a large extent, I would say, is a daunting task. You need lots and lots of work, lots and lots of brain power. But the beauty is, and this is what the quote here is about, that machine learning implements the scientific method on steroids. I love this analogy here, right? Because a machine can come up with hypotheses like in the thousands, in the millions, and rejects it, or if it finds some support, sticks to it, right? And this is where now the thinkers, the researchers, might be replaced by the machines that can work much, much harder 24/7, and they never get tired and need to stop, right? So when people try to figure out in the markets if there is something about patterns, so I'm not pro-pattern, I'm not against pattern, but my argument here is that if there is something to these patterns, and everybody in finance, again, has seen such patterns and how they are used, right? And if there is something to these patterns, the machines are for sure better equipped to recognize these patterns, to learn about these patterns, pattern recognition, right? And to act on these patterns, right? So that's kind of like, sometimes people ask me, how can I teach the machine my favorite pattern? I said, no, machine learning is not about teaching the machine something. Machine learning is let the machine have a look at the data and let the machine figure out what's in there, right? So in that sense, if there is something to these patterns, we should trust the machines to discover it. And in other words, in this context, AI, machine learning, puts the world upside down, and not only in trading itself, right? In trading, when we program, we have rules, we have code, we have patterns, right? We apply data, and then we get the output, a signal, let's say. In machine learning, it's the other way around. We have the data, we have input and output, right? And the machine comes up with the rules and the trading patterns. You have seen probably this chart here in different forms, right? But this is what I meant before. We don't teach the machine anything. The machine teaches itself. We just provide the data, and that's the beauty of it, right? You take out the human being with the limited capacity, cognitive capacity, time capacity out of the equation in the hope that the machine can learn things much better. So in that sense, this chart has many, many things, but the major message is we are coming from a world where we try, based on very simple, elegant theories, to explain an absolutely complex world, right? But we should get to a point where we say, well, we have all the data available, let's have a look at the data, and let's apply general algorithms so that we might see a better performance, even if we cannot fully explain what's happening in this context, right? So that's the major message. We have the data, we have powerful software, powerful algorithms that we can apply to the data. We have powerful hardware these days that we can use, right? Let's have the machines have a look, and maybe the machine figures out stuff that we never even thought possible in this context, right? So that's the beauty. And again, we can, to some extent, eliminate the human element from the equation and can test millions of hypotheses, while human researchers maybe can only test a dozen. So, coming to the conclusions, what can we learn? What do people do, right? What is kind of like, now you might say, well, markets are efficient. What can we do? We have lots of data. We have AI. We can apply AI. We have wonderful technologies. What can I do? And I think there are two basic strategies. Of course, there are more. I just want to simplify, but this is something that you observe in the markets. And I think these basic two strategies represent the left and the right-hand side of a complete spectrum, how you can approach finance, investment, and trading. So basic strategy one, simply saying going all passive. You can say, well, I cannot compete with efficient markets. I cannot compete with the big financial institutions out there. I simply put my eggs into several baskets here, cheap index funds. I try to avoid transaction costs as much as possible. And yeah, I swim with the river, right? I go with the tide and I behave passively. I don't need to spend that much money. I don't need to think. I don't need technology. This is a pretty simple strategy. I'm going all passive. And we see that many people behave that way. So the success of the index fund universe is tremendous. So we started roughly with here when we go to 2008 after the crisis, right? A little bit less than 2 trillion. This is all in the trillion dollars, right? And this is increasing more or less steadily. A little dip here 2018, but from 18 to 19 it has increased tremendously again, and we are now close to 12 trillion. 12 trillion that are managed passively means that we are entering a world of kind of like a self-fulfilling prophecy, right? If everybody believes in efficient markets and if everybody goes passive, then markets will behave that way, because this will reinforce the importance of the indices that are the very underlying benchmarks for these funds, right? So this is one basic strategy. And this is what I think for most of the people out there, it's a wonderful strategy. Avoid transaction costs, go with good providers that mimic the major index funds, where you have the major, I don't know, companies, US, Asia, Europe in there, and some more maybe. And then you're well diversified at low cost, and you don't need to care. Maybe you have a savings plan. That's basically it. But basic strategy two, the other end, we say, well, we have recognized that there are issues with the traditional theories, that markets are maybe efficient, that there are only a few success stories from traditional finance. So let's try to leverage what we have available these days. We have lots and tons of data, 40,000 tick data points for a single stock for half an hour. Let's apply AI approaches. So we go more on the data science side, machine learning side, deep learning side, reinforcement learning side, and try to overcome the course of the lack of good theories, the failures of math in our field, right? And try to overcome efficient markets actively by simply applying new approaches and gaining competitive advantages. Why should this happen? Yeah, here I'm just mentioning one characteristic of deep, and not even deep neural networks. Here it is about shallow neural networks with a single hidden layer. So the theorem thus states that simple neural networks, simple one hidden layer, can represent a wide variety of interesting functions when given appropriate parameters, right? So they can deal easily with high dimensions, with non-linearity, and I think this is something that better describes financial markets than the linear world with normal distribution and low dimensions only, right? This is not something that we find in reality, and maybe the characteristics of these algorithms themselves are well suited to attack our world. So last but not least, here one example. Here's a link on the lightning talk by Peter Kohn. I was looking for a very recent example, right? We employ deep learning in forecasting high frequency returns, high frequency, right? At multiple horizons for 115 stocks traded on the NASDAQ using order book information at the most granular level. So on the left-hand side, you see the number, 10 terabytes of data, data-driven finance, 10 terabytes, right? We achieve state-of-the-art predictive accuracy by training simpler, off-the-shelf artificial neural networks on stationary input. So finally, our proposed approach is similar to that of a real-world production setting where the models are updated on a rolling basis based on our experience from training the deep learning models. I mentioned before what the characteristics are. In this article, across a large number of stocks, we conclude that deploying these models at large scale in practice is fully feasible and no longer a pipe dream. Yeah, I think this is the exact opposite to investing in an index fund, let's say on the S&P 500, to say, well, we have tons of data, terabytes of data that we crunch. Maybe at the same time we apply the latest and the greatest of the machine deep learning approaches, but they implemented it on a high performance cluster. So this is not feasible in general based on standard hardware like a single MacBook back home or whatnot. So again, the extreme opposite. I can invest 10,000 US dollar in an index fund with a single call or a login on the web page. Here we need a powerful cluster, a high performance computer in order to do all that stuff. So coming to the final slide here. Finance has long been driven by the beauty myth. Elegant but too simplistic models, equations and approaches. The availability of big financial data, right? Historical, streaming, structured, unstructured, news, tick data, all these types of fundamental data gives rise to data-driven finance. And it can be assumed that maybe the availability of the big data here and the unreasonable effectiveness of big data holds true in financial matters as well. The availability of big data has brought breakthroughs in many other areas like car driving, right? Self-played games that we have discussed. Artificial intelligence is therefore changing so many areas of our lives. The question is, why shouldn't it change finance? And my conclusion here is, it is to be assumed that in the same way, the combination of data-driven AI-first finance will influence and change finance, investing, and trading for good. Thank you all, and of course, happy for any questions, if there are any.
Yes, sir, we do have questions for you in the chat box. The first one says, is the future of efficient trading in markets is only through AI?
Oh, I didn't get the, is the future of...
Is the future of efficient trading in markets is only through artificial intelligence?
Oh yeah, I see the question. The question is, what is efficient trading? Let's say successful trading, and in many areas such algorithms are already deployed. The question is, what do you use AI for? So I was more or less on the side of saying AI, like in the last example, is used for price prediction. This is what we use it primarily for as well. But there are other areas as well where you have, for example, machine deep learning methods that are applied for optimal execution, right? Considering market impact of your trades. But I would say basically yes. I would basically answer yes, because the algorithms, the machines are simply the better traders, the better predictors, and there are no emotions. And again, you can take out the human element from the equation, and often, more often than not, I think this will have benefits.
Okay, the next question says, people say that AI today cannot replicate the instincts of a seasoned trader or investor. How far in the future do you think that traders might become redundant given the continuous growth in the fields of algorithmic trading and machine learning? What might the field of finance look like in future?
Again, a little differentiation. So there are algorithms and there are AI-based algorithms. So when you have a look at stocks trading around the world, the absolute majority of stocks trades is executed by algorithms. Not necessarily what we understand under AI algorithms, but it's algorithmic trading, right? Meaning that there is some deterministic, stochastic, whatever relationship, whatever algorithm, right, that drives the trading. And this holds true in certain markets up to 80-90%, right? And seasoned traders, experienced traders, I think of course, there are success stories, but if you trust the numbers, when you have a look at retail brokers, at least in Europe, that we are dealing with, you see they are required, the UK ones, to prominently show the number of portfolios that lose versus the number of portfolios that win, and usually you have something like 75-76% of the traders are losing money. So I don't know if this is kind of like a good support for the seasoned and experienced trader. There might be such people out there, but in highly efficient markets such as FX, equities, etc., this probably is not a thing. If you are, let's say, an antique dealer right? And you have special access, that's a different story. But where everything is transparent, where the markets are highly efficient in terms of execution and the speed of execution is on the millisecond level, or even below, it's difficult for people, for human beings simply to keep up. And there's one quote that I used before, and this is related to the 80-90% of executed. Goldman Sachs, this was one quote, and this is years back, had 600 equities traders, and they boiled it down to 2 human beings only. So this is already the case that in trading, most of the human beings that have been involved in the past have simply replaced. There is no floor trading anymore. There is no phone-based trading anymore. So basically, this is already done, right? And now more and more areas are overtaken. Oh, quantum computing. So how might quantum computing change the field of machine learning? Yeah, this is not really related to trading. And I must confess, although I'm intrigued and fascinated by quantum computing, I'm not an expert in the field. So currently I'm sitting on the fences and reading the news here and there. But I think we are still far, far away from having appropriate applications, although the big companies, they have all their research budgets for that topic, but we are still far away from any meaningful real-world practical application that is running 24/7 for the banks. It might change the field considerably, but I think if it does so, it is still quite a bit away. So currently no real threat, or no, let's say positively, no substitution yet for what we currently have available as technologies.
Thank you so much, sir, for your answer. This session was truly phenomenal. It was an honor to learn from you about finance, AI, and how it reshaped the finance industry over time. On behalf of Team Intel, I would like to extend our heartiest thanks to you for graciously taking time out of your undoubtedly busy schedule to join us today and conduct this session. It was a privilege and honor to learn from you, sir. I would also like to thank our sponsors, Design Group, for providing us with the support of the virtual platform. With this, we come to an end of the session. Thank you. Also, sir, a request if you could wait for a group photo.
Thank you very much. Yeah, sure.